Would you not want to know early warning signals that tell you something about your hotel's long-term sustainability, as in the ability to survive over a longer period of time? Well, profitability ratios are those early warning signals. But what are these profitability ratios? Let's take a look at one of the most important profitability ratios for your owner, probably the most important, and that is EBITDA, earnings before interest, tax, depreciation, and amortization. Hang on, this is not an accounting class. I shall explain what this acronym means. But did you know about EBITDA before? As a hotel manager, you should. EBITDA is a profitability ratio that uses two other KPIs, earnings and total revenue. Let's take a quick look at both of them. So, EBITDA, which is a favorite ratio with your hotel owners, has two elements and are being pointed out right now. Now, total revenue means revenue of the entire hotel, and earnings is simply total revenue less all operating expenses plus something called fixed charges, which I shall explain very soon. Now, EBITDA is a profitability ratio. It measures profitability of the hotel before deducting three things: financing costs, taxes, and other non-operating expenses. So note those 3 points about the EBITDA. They bear watching. So it's before deducting financing, taxes, and other non-operating expenses. But you may have a question. What is profitability in the first place? Well, loosely, you could term it as long-term ability to earn profit, or the ability of a business to survive in the long term, which is only by earning profits. But the ability of a business to earn profit has two elements to it. So one is the revenue and the other is the expenses. Hotel needs revenue to continue in business, but expenses create risk in business. So revenue minus expenses results in profit. Now, having said that, let's summarize what this whole profitability is about. Expenses reduce profit. Reduced profit is a risk, so risk is related to profit, and profit is also called earnings. And most importantly, the hotel is a seasonal industry with earnings going up and down. These up and down fluctuations in earnings are what cause that risk. So let's understand now total revenue and earnings, which are key to calculating EBITDA. So what's the formula for EBITDA? EBITDA is being pointed out to you right now. We shall be using the current month's number for EBITDA in order to calculate the ratio itself. So number one is EBITDA, as is being pointed out, divided by total revenue, also being pointed out, number two, and then it's multiplied by 100. Let's apply some numbers to them. EBITDA is 670,999 divided by total revenue, which is 1,645,814. When you multiply that by 100, you get 40.8%. So what does an EBITDA of 40.8% mean? Well, it simply means that the EBITDA percentage is showing you how much the hotel has earned as an operating profit, which is very important for your owners, for every dollar of total revenue. In other words, since the hotel has earned, let's say, $1, you have been able to earn 40.8 cents as EBITDA out of that $1 of total revenue. But EBITDA also shows how well your hotel has managed expenses, particularly operating expenses, to translate revenue into profitability. Now you may have a question. Is there any industry norm for EBITDA? What an EBITDA should be? Well, there's no such thing because EBITDA depends upon many factors. Factors like hotel size, revenue level, and the extent of fixed and variable expenses, which we shall see later. And EBITDA, in this case of 40.8%, is considered pretty good, considering that you've been able to retain 40.8 cents out of every dollar earned. But what does EBITDA actually indicate? Well, it consists of three factors: one, total revenue; two, operating expenses; and three, fixed charges, which I shall explain very soon. In fact, I shall be explaining operating expenses and fixed charges very soon. Broadly, if total revenue increases, your EBITDA will also go up. If operating expenses or fixed charges are managed well, as in reduced, then too, EBITDA will go up. Now, if total revenue or operating expenses and fixed charges, they become negative, then EBITDA will suffer. So, having understood that, let's now understand what operating expenses are. Operating expenses are broadly of two kinds. Number one, direct operating expenses are being pointed out to you. What is shown against number one. And number two are undistributed operating expenses shown against number two. Direct operating expenses are expenses you must incur to earn that total revenue. And notice that these expenses, which are marked number 1, belong to rooms, food and beverage, and retail departments. Why? Because direct operating expenses are from revenue producing departments. Now, direct operating expenses generally take the form of payroll and related and other direct expenses. Let's get to fixed charges now. What are fixed charges? Well, fixed charges are commonly of 3 types. Number 1, rent. This is the rent expense being paid when you rent equipment, when you rent a facility in order to run your business. Number 2 is property taxes. Property taxes are very common. So property taxes are based on the property value, as in your buildings and plant and machinery and the business itself. And number 3 is insurance. This is insurance expenses for all the assets of your hotel business. Now, fixed charges are necessary to earn total revenue. These expenses generally or broadly tend to remain the same. That's why they are called fixed charges. And notice that the fixed charges of rent, property taxes, and insurance do not affect the GOP, which is above it, while they reduce EBITDA, which we are calculating right now, which is below it. Now, what are some ill effects of EBITDA decreasing over time? In this case, the EBITDA is a ratio, as we mentioned earlier, a favorite of owners. Why? Because it's purely operating profit. It's not affected by financing costs, taxes, or non-cash expenses. So owners would like to know EBITDA because they want to know purely what is the profit earned by the hotel by running the business itself. Now, if EBITDA decreases, the final net income, which is what is also known as profitability or bottom line, suffers. We shall see net income in a later video. Now, what should the focus be? Well, the focus should be on total revenue on one side and operating expense and fixed charges on the other. Now, what are some features of EBITDA? There are 3 features of EBITDA. Number 1, it is boosted by higher total revenue. So obviously you must earn more total revenue. And it's boosted by lower operating expenses and fixed charges. But generally, it is boosted by a combination of higher total revenue and lower operating expenses and fixed charges. So you could say EBITDA is a function of revenue on the one hand and operating expenses and fixed charges on the other hand. Let's now recap our understanding of what EBITDA is. Always compare an EBITDA between years. Ensure that EBITDA is not less than the previous year, 2019 versus 18, 20 versus 19, and so on. Similarly, ensure revenue is growing year over year, as is being pointed out, right? And finally, ensure operating expenses and fixed expenses are not increasing over the years. What are 3 key takeaways of EBITDA? Well, EBITDA has 3 key takeaways. Number 1 is, of course, the formula that you take total revenue and reduce operating expenses and fixed charges from it. And secondly, the influence that revenue on the one hand and operating expenses and fixed charges on the other hand have on the EBITDA. What does this influence mean? Well, that brings us to the third takeaway, that you must ensure that revenue is increasing year on year while operating expenses, fixed charges decrease over time. Now that you have known what EBITDA is all about, would you not want to know more about the KPI that is to be calculated before EBITDA, and that's gross operating profit? Well, click on the video above and you will know how to calculate gross operating profit. You will understand EBITDA better.